$32.14. That is the COMEX paper price of silver as you watch this video. Write that number down. Now here's the second number, $47.60. That is what physical silver, 1 troy ounce, same purity, same weight, is actually clearing for in Shanghai's private dealer network as of this week's SGE settlement data. The same ounce, 2 completely different prices. A 15's 46 gap between the paper world and the real world, and that gap has not closed in 11 weeks. It has widened. You are watching this because the mainstream financial press will not show you that second number. They will show you COMEX. They will show you the spot price ticker at the bottom of your screen. They will never ever show you what buyers in the East are actually paying to take physical delivery. And the reason they won't show you is the same reason this gap exists in the first place. Let me explain exactly what is happening, because if you own silver, or if you are thinking about owning silver, the next 6 minutes could be the most important financial information you process this year. The paper price of silver is set in the West. Specifically, it is set on the COMEX, the commodity exchange, which is a division of the CME Group headquartered in Chicago. Every single day, billions of dollars in silver contracts trade on that exchange. On any given day, the notional volume of silver traded on COMEX represents somewhere between 300 and 400 million ounces of silver changing hands on paper. Here's the problem. As of the most recent COMEX inventory report, and these are public filings, you can pull them yourself, the total registered silver available for actual delivery sites at approximately 34. 2 million ounces. Let me say that again. 300 to 400 million ounces traded. 34, 2 million ounces actually there. That is a coverage ratio of between 8 to 1 and 11 to 1 on an average trading day. But when you zoom out and look at total open interest, all the outstanding claims on silver sitting on the COMEX right now, the number is more disturbing. As of the last commitment of traders report, total silver open interest represents approximately 942 million ounces of claimed silver. 942 million ounces claimed. 34, 2 million registered and available. That is a ratio of 27. 5 to 1, 27.5 paper claims for every single real ounce that could actually be delivered. But that's not the part that should concern you. The part that should concern you is what happened between March 14th and April 4th of this year. In that 3-week window, registered COMEX silver inventory dropped by 9, 3 million ounces. That is a 4% drawdown in 3 weeks. And on the days those ounces moved out of registered status, meaning out of the pool available for delivery, the paper price of silver did not go up. It went sideways. On 2 of those days, it went down. Paper says the supply is plentiful. The vault says something different. Now, if you've been watching this channel, and if you're not subscribed yet, do that right now and hit the notification bell, because this is the kind of data I'm going to keep bringing you every single week. You already know that this is not a new phenomenon. This vault drain pattern has shown up before every major silver price dislocation in the modern era. But this time, there are 5 simultaneous signals that have never appeared together before. And Oliver's final warning is not a phrase I use lightly. Let me walk you through all 5. Signal 1 is the vault drain we just covered. 9, 3 million ounces in 3 weeks. Signal 2 is the lease rate. The silver lease rate, the cost to borrow physical silver, just crossed 4. 2% annualized. The last time the silver lease rate broke above 4% was August 2020, right before a 47% price move in 6 weeks. Before that, you have to go back to 2011, right before silver hit $49.51. Coincidence? I don't think so. Once is an accident. Twice is coincidence. 3 times is policy. Signal 3 is the Shanghai Gold Exchange, the SGE, premium. The premium for physical silver delivery in Shanghai over Western paper prices has now held above $12 per ounce for 11 consecutive weeks. 11 weeks, the premium held through every paper dump. The premium held through every algorithmic sell-off. The premium held through 2 separate margin hike cycles. The premium held through the entire dump. When Eastern physical buyers refuse to flinch at the prices Western paper sellers are setting, that is not a market inefficiency. That is a market bifurcation. And market bifurcations do not last forever. One price eventually breaks toward the other. Signal 4 is mining output. The Silver Institute's most recent supply report, published in February, projects global mine supply at 843 million ounces for 2025. Global industrial demand alone, not investment demand, not jewelry, not silverware, just industrial solar panels, EVs, semiconductors, medical devices, is now running at 701 million ounces annually. That leaves 132 million ounces for every other category of demand combined. That is before a single stacker buys a single coin. Before a single ETF buys a single bar. Before a single central bank adds a single gram. The math does not work, and the people who understand the math are moving accordingly. Signal 5 is the one that made me record this video today, but I'll get to that in a moment, because first I need to show you the pattern, because this isn't random. This has happened before. In January 1980, silver hit $49, 45 an ounce. In April 2011, silver hit $49, 51 an ounce. 31 years apart, within 6 cents of the same price. Same playbook, different decade. That is not a coincidence. That is a ceiling, an invisible institutional ceiling that has been actively managed for over 4 decades. Now understand what I am about to show you, because this is where the data gets genuinely disturbing. Between 2019 and 2024, JPMorgan Chase paid over $920 million in fines and penalties to the Department of Justice, the CFTC, and the SEC for what federal prosecutors described as a massive multi-year scheme to manipulate the market for precious metals futures contracts. Those are not my words. Those are the words in the federal indictment. JPMorgan traders were convicted of racketeering, the same statute used against organized crime. The racketeering conviction is a matter of public court record. Now here's the question nobody in mainstream financial media is asking. If the manipulation was real, and a federal court confirmed it was real, why would you assume it stopped the moment the fine was paid? Wall Street is not confused. They know exactly what this means. Let me show you the current fingerprints. Between January 2025 and March 2025, a single entity, consistently holding what the CFTC classifies as a concentrated short position in COMEX silver futures, increased its net short position by approximately 87 million ounces. 87 million ounces of additional short pressure added in 10 weeks. That is more silver than Mexico, the world's largest silver producing country, mines in 4 months. And here's what they filed at 3 a.m. that nobody is talking about. The bank participation report published on March 7th shows US banks now hold a net short position in COMEX silver, representing 4 million ounces. 312 million ounces short against a registered inventory of 34. 2 million ounces. This number doesn't exist in a fair market. Let me show you why this matters historically. In early 2020, US bank net short positions in COMEX silver were sitting at approximately 280 million ounces. Silver was priced around 17. By August 2020, that short position began to rapidly unwind, not because the banks became generous, but because physical demand in Asia was overwhelming their paper pressure. Silver went from 17 to $20 in 6 weeks. A 70% move. In 2010, the same pattern. Concentrated short positions. SGE premiums building, lease rates spiking. And then, when the physical market finally overwhelmed the paper market, silver went from $18 to $49. A 172% move in 7 months. Once you understand the ratio, the price action makes sense. The ratio I am referring to is not just the 27, 5-to-1 paper to physical ratio on COMEX. I am talking about the gold to silver ratio. As of today, that ratio sits at approximately 89-to-1. 1 ounce of gold buys 89 ounces of silver. The historical mean over the last century is 47-to-1. The mean during periods of high industrial demand, which is exactly where we are today, is closer to 30-to-1. If gold holds at its current price of approximately $3,200 per ounce, and the gold to silver ratio simply returns to its 100-year average of 47, silver prices at $68. If the ratio drops to 30, where it was during peak industrial demand periods in 1979 and 2011, silver prices at $106 at current gold levels. But gold is not staying at $3,200. Central banks bought 1,037 tons of gold in 2023. They bought 1,045 tons in 2024. The pace in Q1 2025 suggests annualized buying above 2,200 tons. The People's Bank of China has publicly disclosed 18 consecutive months of gold reserve additions. India's RBI brought 72 tons back from the Bank of England in a single transfer. The West is still pricing this like 2019. The East stopped pricing it like 2019, approximately 3 years ago. If gold moves to $4,000 and the majority of institutional price targets now sit between $3,800 and $4,500, and if the gold to silver ratio normalizes even to 40-to-1, silver prices at $100 per ounce. At 30-to-1, it prices at $133. But let me tell you why the $500 silver by summer 2026 number in this video's title is not the hyperbole it sounds like. Let me tell you about Signal 5. Because here's what they filed, and almost nobody has connected the dots yet. The Basel III net stable funding ratio requirements for unallocated precious metals, which is regulatory language for paper silver positions held by banks, are being phased into full enforcement in several major jurisdictions in the back half of 2025. What that means in plain language is this. Banks that currently hold massive unallocated silver positions, paper claims, will be required to hold significantly more capital against those positions. The cost of maintaining enormous concentrated short positions just went up dramatically at the regulatory level. At the same time, and this is the simultaneous squeeze, industrial demand for physical silver from the solar sector alone is projected to hit 273 million ounces in 2026. That is up from 161 million ounces in 2023. Solar alone is consuming silver at a rate that is accelerating 20% year over year. Now add the regulatory short squeeze, add the physical drain from COMEX vaults, add the SGE premium that has refused to close for 11 weeks, add the lease rate that just broke 2%, and then add what I found buried in the most recent CME Group quarterly earnings release. Between Q4 2024 and Q1 2025, COMEX silver futures delivery requests, actual requests to take physical delivery, increased by 340%. 340% in one quarter. The number of entities standing for delivery, refusing to roll their contracts, is at its highest level since 2020. The gap didn't close, it widened. And there is a scenario, a mathematically coherent scenario, not a fantasy, where the attempt to deliver against those contracts breaks the paper pricing mechanism entirely. What happens when 5 paper claims start fighting over 1 real ounce? What happens when the entity holding the short position cannot source the physical silver to make delivery? We saw a preview in January 2021 with the Reddit Wall Street Bets silver squeeze. In a single week, retail buying pressure pulled enough physical silver out of the system that premiums on retail silver coins hit 30% over spot. The paper price moved $5, but if you wanted to actually buy a silver eagle or a maple leaf, you were paying $39 for a $34 coin. Paper says one price. The vault says something different. The difference in 2021 was that it was retail buyers, disorganized, short attention span, no staying power. What is happening now is not retail buyers. It is sovereign entities. It is central bank adjuncts. It is industrial consumers who are locking in physical supply because their procurement departments have done the same math you and I are doing right now, and they don't like what they see. Smash that like button right now. It takes 1 second, and it helps the algorithm put this information in front of the people who need it most. And if you are not subscribed yet, do it right now. I am not going to ask you to trust me. I am going to keep showing you the data and let you decide. Because here's where we are. We have a manipulated paper market that has held silver below $35 for months, while the physical market is telling a completely different story. We have vault drawdowns. We have lease rate spikes. We have an SGE premium that won't close. We have regulatory changes that are about to make the short position expensive to maintain. We have industrial demand that is structurally outrunning supply. And we have historical precedent, 1979, 2010, that shows exactly what happens when these conditions converge. But here is what should really disturb you. The $49. 51 ceiling that held in 2011, the same price that held in 1980, 31 years earlier, has already been broken in non-US dollar terms. In British pounds, silver already set an all-time high in 2024. In Japanese yen, silver is already at its highest level in 40 years. In Australian dollars, in Canadian dollars, in Indian rupees, silver has already broken out. The only major currency in which silver has not broken above its 2011 highs is the US dollar. And the US dollar has lost 23% of its purchasing power since 2011. So either silver in dollar terms has to catch up to what it has already done in every other currency on the planet, or the dollar is going to keep doing what it has been doing for a century. Which one do you think is more likely? Let me tell you who gets hurt first. The people who get hurt first are not the stackers. The people who get hurt first are not the viewers of this channel. The people who get hurt first are the people who are sitting in SLV, the iShares Silver Trust ETF, thinking they own silver. Here's what SLV actually is. SLV holds allocated silver in HSBC vaults in London. On paper, each share represents approximately 0.93 of a troy ounce. But the SLV prospectus, and I encourage you to read it, it's publicly available on the SEC website, explicitly states that the trust may hold silver through sub-custodians, and that the trust's silver may be commingled with silver owned by other parties, and that in the event of a sub-custodian default or insolvency, shareholders may have limited recourse. You are not holding silver. You are holding a claim on silver. You are 2 layers of paper away from the physical metal. In a normal market, that is fine. In a dislocated market, in a market where 5 paper claims are fighting over 1 real ounce, that distinction becomes everything. There are 3 types of people watching this video right now. Type 1 is panicking. They saw silver spike and pull back, and they sold. They are refreshing their brokerage app every 20 minutes wondering if they made a mistake. I want to say this directly. Panic is the mechanism by which your wealth transfers to someone else's pocket. Type 1 investors don't lose money because the market goes down. They lose money because they sell when the market goes down. Type 2 is frozen. They believe the thesis, they see the data, but they can't pull the trigger because the paper price keeps getting capped and it feels like the manipulation will last forever. Type 2 investors understand more than Type 1, but their paralysis produces the same outcome. You cannot benefit from a thesis you won't act on. Type 3 is watching this video with a notepad. They understand that the manipulation doesn't change the destination, it changes the timeline. Type 3 investors know that a cap held artificially below fair value is not a reason to avoid an asset. It is a reason to accumulate it at a discount before the cap breaks. The West is still pricing silver like 2019. The East stopped doing that 3 years ago. Now let me be direct about the $500 number. This is not financial advice. Your money, your decisions. I am going to present the math and let you evaluate it. For For silver to reach $500, and one of two things needs to happen, or both. Path 1, the gold to silver ratio returns to its pre-financialization historical level of approximately 15 to 1, which is where it sat before paper silver markets existed. At current gold prices of $3,200, a 15 to 1 ratio implies silver at $213. If gold moves to its institutional target range of $4,500, a 15 to 1 ratio implies silver at $300. Still not $500, but we haven't added the dollar debasement component yet. Path 2, a genuine physical delivery failure on COMEX. Not a default. The CME group can change delivery rules to prevent a formal default, and they have done this before, most infamously in 1980 when they changed the rules mid-game to stop the Hunt brothers. But a forced cash settlement at a price significantly above current spot, a forced acknowledgement that the paper price and the physical price are not the same thing, could reprice silver in a single week. In 1980, when the Hunt brothers cornered the silver market, silver went from $11 to $49, $45 in approximately 12 months. That was without the industrial demand component that exists today. That was without central bank de-dollarization. That was without a $3,200 gold anchor. That was with a functional physical market. The physical market today is not functional. It is bifurcated, and the bifurcation is widening. When this breaks, not if when, the initial price movement will be faster and steeper than anything you have seen in silver before. Because this time, it is not one family trying to corner a market. It is the aggregate industrial demand of the global solar build-out, plus the sovereign wealth accumulation of Eastern central banks, plus the regulatory short squeeze of Basel III, all arriving simultaneously into a market with 34. 2 million registered ounces in the vault and 942 million ounces of paper claims outstanding, and this time, the mainstream financial press will not see it coming, because they are still looking at the COMEX ticker. Here's what you should understand about the by summer 2026 framing. The Basel III NSFR enforcement window that I mentioned, the regulatory mechanism that increases the capital cost of maintaining large, unallocated precious metals short positions, has a key compliance review date in Q2 2026 for several major institutions. Specifically, there are European banking regulatory filings due by June 30th, 2026 that will require public disclosure of unallocated precious metals exposure. When those filings hit, when the world can see in black and white how large these unallocated short positions actually are, the pressure to cover, to buy back, to close positions will become institutional rather than retail. And institutional position covering in a thin physical market does not produce orderly price discovery. It produces vertical moves. Same playbook, different decade. In 1979, it happened fast. Faster than almost anyone predicted. The people who were in position before it happened, the ones who did not panic out and did not freeze, those are the people who saw generational wealth creation in a 12-month window. Wall Street is not confused. They know exactly what this means. The question is whether they cover their shorts in time, or whether they get squeezed covering into a physical shortage. I need you to understand the asymmetry here. If you own physical silver and the manipulation continues for another 2 years, you hold an asset with significant and growing industrial utility, a 5,000-year monetary history, and a price that has been artificially suppressed below its cost of production for several mining companies. The downside is you wait longer. If you own paper silver, SLV, SIVR, or leveraged ETFs, and this breaks the way the data suggests it will, you will discover on a Tuesday morning what cash settlement means. The paper price will move. Whether you can actually get physical silver at that price is a different question. If you own nothing and this move happens, you will watch $500 silver from the sidelines and tell yourself you knew it was coming. And you will be right. And it won't matter. Let me give you a specific subscription prompt here, because what is coming over the next several weeks on this channel is going to matter for your portfolio. Every week between now and that Q2 2026 Basel III compliance filing date, I'm going to be tracking 5 specific data points: the COMEX registered inventory level, the SGE physical premium, the silver lease rate, US bank net short positions from the CFTC bank participation report, and COMEX delivery request volumes. If those numbers start moving in the direction the pattern predicts, and I will tell you the specific thresholds that would confirm a breakout is imminent, you want to be subscribed. You want that notification bell on, because this is the kind of move where timing matters in weeks, not months. Screenshot this video, hold me accountable. Come back and tell me I was wrong if I'm wrong. I will make a follow-up video and we will look at the evidence together. Now let me tell you what the smart money is actually doing, because there is a paper trail and it is not subtle. Eric Sprott's PSLV, the Sprott Physical Silver Trust, has taken in over $340 million in net new capital in the first quarter of 2025 alone. That is institutional money. That is family office money. That is not Reddit. These are accredited investors who have read the same COMEX inventory reports I just walked you through, and they are moving capital into a vehicle that holds allocated, audited, unencumbered physical silver in the Royal Canadian Mint. They are not buying SLV. They are specifically not buying SLV. They are buying the thing where, when you ask where the silver is, someone can point to a specific bar with a specific serial number in a specific vault. Why does that distinction matter right now? Because if the paper price breaks from the physical price, if we see a genuine dislocation event, allocated physical trusts will track the physical price. Unallocated paper products will track whatever the CME group decides to print as a settlement price. And here's the last thing I want to say before I leave you with the question that is going to keep you up tonight. The narrative that $500 silver is impossible, that it is the fantasy of permabulls and gold bugs, rests entirely on the assumption that the current pricing mechanism continues to function. It rests on the assumption that 5 paper claims can continue to coexist with 1 real ounce indefinitely. It rests on the assumption that the SGE premium closes because Western prices go up rather than Eastern prices holding and Western paper pressure eventually collapsing. Every single historical precedent says that assumption is wrong. Paper always loses to physical eventually. Always. In 1980 it broke. In 2011 it nearly broke and only held because the CME group hiked margin requirements 5 times in 8 trading days to crush the retail long side. They literally changed the rules of the game in the middle of the game to prevent a delivery squeeze. Can they do that again? Yes, they can. And if they do, they will confirm everything this channel has been documenting, and silver will spend 3 to 6 months at suppressed prices before the industrial demand reality reasserts itself at higher prices than before the manipulation. Either way, the direction is the same. The manipulation delays. It does not prevent. Once you understand the ratio, the price action makes sense. And send this to one person. One person you care about who is sitting in paper silver right now and doesn't know the difference between allocated and unallocated. Send it to the person in your life who keeps asking you why you own physical silver when the price hasn't moved. One share of this video might be the most financially valuable thing you do today. The West is still pricing this like 2019. The East stopped doing that 3 years ago. At some point, those two pricing regimes cannot both be right. Let me leave you with exactly what Oliver's final warning is. Oliver warned, in a research note published in February and circulated to institutional clients, that we are entering a 60 to 90-day window in which the conditions for a COMEX silver squeeze are more aligned than at any point since 2020. He pointed to 5 signals: vault drawdowns, lease rate spikes, SGE premium persistence, Basel III regulatory pressure, and delivery request acceleration. I have walked you through all 5 tonight. You have seen the data yourself. The warning is not that silver will definitely hit $500 by summer 2026. The warning is that the system which has kept silver below $35 for the past 2 years is under simultaneous pressure from 5 directions that have never appeared at the same time before. And systems under simultaneous pressure from 5 directions do not unwind gradually. They hold and hold and hold it, and then they don't. Subscribe to the Hidden Economy. I am going to keep tracking every one of these 5 signals every single week. When one of them breaks, and I will tell you exactly what breaks looks like in numerical terms, you will know the same day I know. Drop in the comments your silver price target for summer 2026. I want to see the range, and tell me, final warning, if this video changed something for you. I read every single comment. There is one question I cannot answer tonight, and it is the question that should be keeping everyone who manages wealth up at night. The June 30th, 2026 Basel III filing deadline is 11 weeks away. Between now and that filing, between now and the moment when the world can see exactly how large these unallocated short positions actually are, what happens to those 9? 3 million ounces that left COMEX registered inventory in the last 3 weeks? Where did they go? And who is holding them? Come back for the next video, because I have started to find the answer, and the answer points somewhere that is going to change how you understand this market entirely.